Today's a special day. I think a day worth celebrating. It's the first time I've been at an in-person conference for quite a bit of time, and that's in itself pretty exciting. I want to talk about the conference today. It was an economics seminar at Stanford, and the topic was climate finance. So there's a couple of things I want to say about this. I think three main points. I think climate finance it's a bad question, and therefore it leads to questionable modeling and questionable results and all those kinds of things. Nevertheless, I think the second point I want to make is that there was a very interesting paper actually, which was presented by a lady, and it was about the ECB and the ECB's attempt to buy bonds and stocks to help the European economy, and therefore was doing supposedly market neutral QE, but in fact it wasn't. So I want to talk about this relationship. And third, actually, a conclusion that I got from listening to the lady, and this was sort of real-time thinking and a beautiful example of how ideas work. You know, I just got this idea out of pretty much nowhere that when we talk about things like market neutrality and stimulating investment, sometimes it's not as obvious as you might think. So in this particular example, the thesis that a lot of scholars are perpetrating is they're saying that central banks, namely the ECB, by buying bonds and stocks of European stocks, that they're promoting dirty energies, because those stocks that are prevalent in the European capital markets are all dirty in a sense. They're carbon emitting energies. And my point is that's not quite true. By lowering the cost of capital for these types of industries, they're enticing private capital to go into more interesting startups. And I think startups are eventually the only place where real change will happen. So in other words, by lowering the cost of capital, in other words, lowering the interest rates across the economy, in particular lowering the interest rates and yields and increasing the price earnings ratio of, let's say, dirty energy companies, they're moving private capital down the risk curve into more innovative technologies. And in the end, the only place where change will happen is where disruption can happen. And disruption is what really matters. This is Clayton Christensen. And therefore, actually, those actions, they had maybe an unintended consequence, but they did have a consequence. This is the Not Even Wrong podcast. It's September 12, 2022. This is Krim Telco. For the day, the fund is up 1.6%. The market is up 1.1%. For the year, we are down 23.4%. The market is down 14.5%. We're underperforming by 9.9%. So there's three things I want to talk about today. First, the conference that I went to, the economics conference at Stanford, and sort of my first in-person event, actually. It was about climate finance, and I just want to mention a few things about this. I think the word climate and anything related to it, climate X, climate finance, climate policy, climate investing, whatever you add to the word climate, it's a bad start. I discourage people from being involved in those types of things because they're bad problems. The word climate doesn't mean anything. Yes, we have a sense for a certain problem that's out there, some sort of global warming, maybe massive change in global patterns of weather, or you see, I don't know exactly. You ask 10 scientists, what is the climate problem? You will get 11 answers. Therefore, it's a bad problem. Now, to be fair, in this conference, the scholars that were presenting papers were focusing on decarbonization. So implicitly, they actually did what we at Orange Capital Partners are doing, which is we do want to invest in climate initiatives, but we define them as decarbonization initiatives, because that's a clear problem. If you want less carbon in the world, that's something you can actually achieve and measure. And therefore, it's a good problem. Now, if it's really a good problem, or maybe not, that's a different conversation. I don't want to have this conversation right now here in this particular episode, because that's a long-term conversation. Nevertheless, fundamentally, investing in decarbonized infrastructure, be it energy, transportation, and you name it, is a good thing. So, and the scholars have been focusing on that. So I have to give them kudos for that. But nevertheless, just talking about climate in general is a little bit dangerous. And as a side point, it's been a long time that I've been involved in economic discussion with economic scholars. I have a master's from Chicago. I've been involved as a columnist and hedge fund manager here and there with economics theory. But I haven't been involved deeply for quite a while. And my conclusion today is that this is a very abstract, unfortunately, very abstract science. The reason it's abstract is actually it's by design, because what basically economic theory does, at least this type of theory where we talk about macro theory, it is they ask a question, then they create a model, and then they analyze the model. So it's a lot about the model. It's about modeling the world. And like one of the presenters, Nobel Prize winning economist from Chicago, the name eludes me, I put in the show note. He actually says it in his Nobel Prize acceptance speech, where he says, look, we economists, we build models, and by definition, the models will not reflect reality. The goal of a model is to simplify reality, and therefore the model will be wrong. And the question is not, is the model reflecting reality? The question is, how good does the model capture the question at stake? So I think in that sense, I want to give the scholars kudos here. They've been very good at trying to answer certain questions, not all of them, and there's been definitely some better papers and worse papers and all of that. But nevertheless, I think that's how we should look at the science in general, this particular case, economic science, but that's how science works. You have a certain conjecture, and then you build a model, and then you test it. So in that sense, economics is like every other science. Unfortunately, the testing, let's say there was a paper presented by a lady, she wanted to quantify how much carbon avoidance will benefit the economy. And those are, in my view, incredibly difficult questions, and maybe not the best questions, and therefore also the answers are not very good. So having said that, now let me get to the second point, which I think is a lot more interesting, and that is, like I said in the prelude, the question of central bank intervention when it comes to green policy. And there's two shades to that. One is the question, okay, should central banks get involved in equity markets? And the answer is no. But if they do, try to be neutral. That's been the party line by the ECB, the Bank of Switzerland, and so on and so forth, National Bank of Switzerland. The Fed hasn't done it officially, but of course we could argue that even the Fed implicitly is doing it by supporting, let's say, mortgage-backed securities and those types of things. But let's not go there now. The point is this. Okay, by buying, let's say, European indices, which is what the National Bank of Switzerland has done, you're buying companies which are highly capitalized in that particular index. And those companies tend to be, let's say, dirty companies, companies that are not climate driven. So therefore, there's a policy mismatch between the ECB and the European Union, which is trying to be pro-climate, and the financing, which is going into so-called dirty industries. So this is what the paper presented. The paper was, of course, a little bit more granular. She spoke about things like the factors that affect a certain investment. So this is, I guess, Eugene Fama level of finance, where you talk about the factors that drive a certain investment. And therefore, if a central bank wants to be neutral, the bank should analyze, not just buy an index, but maybe look at the factors and try to be neutral relative to the factors being factors affecting the holding of a security. In other words, risk factors to the company And if, let's say, there's a vector of 20 factors, one of them being macroeconomics, the other weather, the third maybe population growth, I don't know, all kinds of factors, whatever the factors are, you want to be neutral to those factors. So the lady was a little bit more granular, and then she also, as a conclusion in the paper, presented some learnings from the paper, and some of those learnings were, for example, that as an academic community, we can learn from this experience by factorizing investments, and then maybe learn also what market neutrality actually means, which is definitely an addition to the investment community, because we often talk about market neutral also as hedge funds and all that stuff, and we don't really know what that means. So to have a more clear, precise understanding for what market neutral means would be beneficial. Now the conclusion, or my personal conclusion, which is congruous with the lady's conclusion, is that there's no such thing as market neutrality. Whenever you get involved, you start changing the relative pricing or the relative exposure to those risk factors that affect companies, and therefore you change the dynamics. And this is now the third point. This leads me to the third point, which is actually interesting for myself, which is that I believe that the central banks, by pushing down the yields of government bonds and then corporate bonds, and actually pushing down earnings yields or increasing valuations of stocks, have indirectly helped climate investments or green investments, because they've lowered the cost of capital to the extent the private capital was channeled into more risky investments, more startup investments. And my thesis is that real change only happens through disruption, and disruption only happens in startups. In other words, incumbents don't actually pursue any kind of change. Incumbents are only interested in market share preservation. Incumbents do what incumbents are supposed to do, which is preserve market share. So there's nothing wrong with that in per se. But I think there's a fallacy, and there's something that the economic scholars should, I think, pay more attention to, and particularly financial economists, which is that investment, the way we understand it within the corporate structure, is not the kind of investment that I think we imagine it to be. So meaning, let's say, things like R&D and those sort of things. In practice, most of R&D, it's not all across the board, but most of R&D and most of investments and most of efforts that companies make are about market share preservation, short-term market share preservation. So if you look at one example would be the relationship of sales and marketing efforts to R&D. And I would argue that in 95% of companies across all sectors, sales and marketing always trumps R&D. Not everywhere, but almost everywhere. And if you really adjust for cost accounting biases and whatnot, because it's sometimes not clear what is actually R&D and what is sales and marketing. But if you adjust for all of that, I think sales and marketing always trumps. And sales and marketing is a proxy for short-term market share preservation efforts, and R&D, the real R&D, which is thinking long-term about where the industry is going, trying to change the way the industry is working, and particularly when it comes to what scholars call green investments, or in other words, you want to try to change the way an industry is operating and decarbonize an industry. For those sort of things, you need disruptive change. This is Clayton Christensen's argument that real economic growth only happens through disruption. And all this other stuff that we call growth and R&D, and that's not real growth, because it's a zero-sum game. It's market share preservation. In fact, it's almost negative growth, because if you take a large company like GM or Coca-Cola, their efforts are what I would summarize Warren Buffett type efforts, where you try to differentiate yourself enough from the competition, build a fortress, and then not let anybody get close to you, and expand and become bigger and bigger, but not bigger by offering more value for less, but by actually increasing price. So you try to rent seek your way through the economy by increasing the share of wallet that you get from customers at the expense of customers. So you're not increasing your share of wallet, let's say like Tesla's doing, where they're getting more money, but they're also giving you 10 times more value you're delivering the same or less value and still increasing the share of wallet. So this is the kind of investment and kind of growth that most of the economy is exposed to and that we discourage. What we encourage here on Capital Partners is disruptive growth, and that can be achieved. And now this is my thesis. If central banks lower the cost of capital, which starts with lowering the risk-free rate and then keeps going down the curve, if they do that, then there is a sort of a quantum leap, which means it's not linear, but there's a certain level of rates, and let's say there's somewhere between 1% and 2% on the risk-free rate. Once that happens, a lot more private capital starts flowing into disruptive change, and that's a good thing. And that actually fosters investments, let's say, in green energy. And we've seen that. At this point, I can only anecdotally attest that, but having been in the trenches myself in the last couple of years, when the rates hit zero and negative in Europe and zero here, or not even negative here for a while, there was a massive flow of capital into any kind of disruptive technology. Of course, having said that, there is almost immediately the caveat, well, there's a lot of capital misallocation. Maoshi-san, SoftBank, WeWork, you name it, even now with A16Z and things like that. It's still pretty bad in a sense that we have this institutionalization, monopolization of VC money and therefore misallocation of capital. It's happening. Nevertheless, if you have any kind of hope for disruptive change, or any kind of change, actually, change and disruptive change are almost synonymous, because there is no other change. Again, there is no other change. If you want change, you need to lower the cost of capital to the point where companies start getting money, companies that whose mission is to change, who are in the business of change, who don't just change to do some sort of facelift or sound good in their annual report or something like that. They change because that's exactly what their business is. That's why they exist. So again, if you lower the cost of capital enough, you can get to that point. And that's what the ECB did. That's what the Fed did. And therefore, there was an unintended consequence of this slush money which was going around. And that was the ability for startups to get money. And we've seen that again. We've seen that on the big scale with companies like Tesla. We've seen it in many, many startups. Even we're still seeing it, but of course it's now a little bit less because rates are up now and cost of capital is going up and all that. But still, what I'm propagating here is that the discount rate or the risk-free rate is probably by far the single most important determinant of change. And the lower that discount rate is, the more likely you will get change. This is the conclusion. And I think this is pretty important. I think this is something that Fed officials should take at heart. That if you lower the discount rate enough, you will get change and you will get growth. This actually works because growth defined as disruptive change will happen more likely. And now, of course, and this is very Popperian, we have solved the problem, but we created many new problems. Good problems. For example, questions such as, well, we had low interest rates in Japan. Why didn't it work there? We have low interest rates in the US. It's working pretty well. And we have very low interest rates in Europe, and it's working so-so. Switzerland is an example where low rates are still very low, where you do have pretty good growth. It's not the way it should be. I am Swiss myself, and I'll be the first to raise my hand to point out institutional and social barriers to growth and innovation. Nevertheless, Switzerland is doing pretty well. France is not doing very well, given how low the rates there are still. So there's questions of infrastructure, of social, institutional barriers, and all these kinds of things, which are good problems, which are problems that economists could be working on, which is, okay, we lower rates, we get disruptive change in Silicon Valley, in other parts of the US, in places like Switzerland and Singapore, but we don't get it in Germany and France. Why is that? How can we foster that? So those are interesting questions. But again, solving for one of the biggest problems, which is how can we induce change, instead of doing all the stuff that people are doing with grants, with NIH, and all of these things, which in our opinion are bad things because they foster corruption, actually lowering the cost of money, lowering the discount rate to a point where it's so low that the present value of far future cash flows becomes very valuable and therefore entices long-term, interesting, research-driven thinking, is one of the best policies the Federal Reserve could do. And therefore, that would be my one argument that I have where I prefer an inflationary fiat to Bitcoin. That's the one argument, because hard money doesn't allow for that. And then we have to ask ourselves, how does change happen with hard money, which is again, a good problem, a very good problem. And that's another nice graduate school research project, PhD. Okay, if we lower rates enough, we get change. I think we've seen that. We get disruptive change. Do we get it with hard money too? How will hard money affect long-term thinking of entrepreneurs? Those are very interesting questions. And I'm very happy that I went to this seminar. I think it just shows how important it is to put yourself out there, to get involved, to think and be surrounded with academics. It doesn't matter what the fields are, almost. I happen to be an economist, so for me this is a little bit easier. I'm able to spar with Nobel Prize winning economists. I wouldn't be able to do that with physicists or psychologists. But I can do it with economics, and that's fine. And other people, this is just sort of a side note. If you have an inclination for English, then do it, but go out there and get yourself in the weeds with people who think for a living, because that's what academics do, and that's a good thing. You can argue about their models and their effectiveness and all that kind of stuff. But the one thing that they're good at is thinking. They think, and they think in interesting ways, good ways. And that fosters ideas, and that's what happened to me today. So to summarize, my first in-person meeting, it was a seminar at Stanford, economic seminar about climate finance. The 3 points I wanted to get across in this episode: number one, the word climate is a bad problem. I think I'd rather have the decarbonization formulation of the problem, which actually happened in the seminar, so I was happy about that. Second, I think that the Federal Reserve and the ECB, by printing money or buying, not printing, but by getting involved in buying bonds, and in the case of Europe, even stocks, certainly has not been able to be market neutral. Nevertheless, one of the ladies in this seminar presented a paper where she argued that it was a good thing because at least the idea of market neutrality was put out in the open, and now we can think about what it actually means, which is an important problem. And third, I think that, this is now my opinion, that having lowered rates is the single most important thing that the Federal Reserve and the ECB could have done to foster change, which is to foster disruptive innovation. And that's the only source of change that we get. So lowering rates is very interesting and opens new questions, interesting questions. Two of them. One is, why does it work in places like the US and not Japan? Another question would be, how does hard money relate to innovative change, disruptive change? Do we get that same innovative change with hard money? Or is this something where fiat has an edge on hard money? Thank you.